Ladies and gentlemen, good day and welcome to the Max Healthcare Institute Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Suraj from CDR India. Thank you, and over to you.
Thank you. Good morning, everyone, and thank you for joining us on Max Healthcare Q4FY23 earnings conference call. We have with us today Mr. Abhay Soi, Chairman and Managing Director, and Mr. Yogesh Sareen, Senior Director and Chief Financial Officer of the company. We will begin the call with opening remarks from the management, following which we will have the forum open for an interactive question and answer session. Before we start, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you already. I would now like to invite Abhay to make his opening remarks. Thank you.
A very good morning to everyone. I'm pleased to welcome you to Max Healthcare's fourth quarter earnings call. At the outset, I would like to state that this has been a seminal year for Max Healthcare on many accounts. An important one of them being the overall translation of rupees 1,636 crores of EBITDA to rupees 1,281 crores of free cash flows. Consequently, in spite of a decadal opportunity for investment in the hospital sector, we have been encouraged to declare our maiden dividend. Now, I want to go into proceedings of Q4. Q4 was a robust quarter for us and exhibited results of commendable execution of our strategy by teams on the ground. This quarter once again reflected our best ever performance across nearly all the financial and operating parameters, recording a significant growth year on year. We commissioned and operationalized a 92-bed oncology block at Max Shalimar Bagh from 1st March. This contributed positively to both revenue and EBITDA in its very first month of launch. EBITDA margin on the incremental revenue was in the range of 35 to 40% due to operating leverage, and overall occupancy at the hospital was 83% in Q4. We expect this to contribute to improvement in EBITDA, both in absolute and margin terms in the ensuing quarter. Now coming to the key highlights of our Q4 performance. Occupancy for the quarter improved to 77% from 68% in Q4 last year and remained at the same level as in the previous quarter. However, it is pertinent to note that operating capacity moved up by 100 beds in March 2023 compared to December 22. Institutional bed share fell to 29% compared to 33% in Q4 last year and remained flat compared to the previous quarter. But again, there was a higher capacity in the current quarter as well. PSU tariffs for room rent and consults have been revised in mid-April. Further discussions are ongoing to increase tariffs for packages and diagnostics, etc. In view of these developments, we have not taken a hard call yet for some of the major accounts. At the same time, all our hospitals have been tasked with improving their operating occupancy thresholds to accommodate growth in the preferred channels. Network gross revenue was 1,637 crores compared to 1,298 crores in Q4 last year and 1,559 crores in the previous quarter. This reflects a growth of 26% year-on-year and 5% quarter-on-quarter. Year-on-year increase was driven by growth in ARPOB and occupied bed days. Revenue from international patients grew by 43% year-on-year and 10% quarter-on-quarter. This now accounts for around 9.1% of the revenue from hospitals and amounts to 120% of pre-COVID levels. Digital revenue grew to rupees 292 crores and accounted for 18% of overall revenue. Led by improvement in channel mix and specialty mix, ARPOB for the quarter rose to approximately rupees 70,700, reflecting a growth of 11% year-on-year and 6% quarter-on-quarter. We reported our highest ever network operating EBITDA of rupees 437 crores compared to 304 crores in Q4 last year and 419 crores in the previous quarter, reflecting a growth of 44% year-on-year and 4% quarter-on-quarter. The network operating EBITDA margin stood at 28.2% versus 24.8% in Q4 last year and 28.3% in the previous quarter. Annualized EBITDA per bed, most importantly, rose to 70,30,000, yet again our highest ever, clocking a growth of 25% year-on-year and 5% quarter-on-quarter. Profit after tax was rupees 320 crores versus 172 crores in Q4 last year and 269 crores in the previous quarter. Year-on-year growth to 85% was primarily attributable to improvement in operating metrics of all the hospitals and lower finance costs. Free cash flow from operations stood at 425 crores, of which 65 crores was deployed towards ongoing capacity expansion projects. The net cash position improved to 733 crores at the end of March 2023 compared to net debt of 441 crores last year. Continuing our efforts to give back to the community, we treated approximately 36,600 OPD and 1,200 IPD patients from economically weaker sections of society free of charge. Both our strategic business units continued to maintain their growth momentum. Max at Home reported a top line of 37 crores, reflecting a growth of 26% year-on-year and 2% quarter-on-quarter. Max Lab reported a gross revenue of rupees 31 crores, reflecting a like-to-like growth of 57% year-on-year and 10% quarter-on-quarter. Now coming to the overview of the company's financial performance for the full year ended 31st March 2023. Network gross revenue stood at 6,234 crores, reflecting a growth of 18% on a like-to-like basis. Network operating EBITDA stood at 1,636 crores, registering a growth of 25% on a like-to-like basis, while ARPOB improved by 15% due to price and improvements in payer mix and case mix, leading to margin expansion by 152 basis points. EBITDA per bed grew by 22% year-on-year and touched a new high of 65.9 lakh rupees. The current status of expansion projects coming on stream by FY 2025 is as follows. We have recently signed an ATS for purchase of land to enable expansion of Max Vaishali, which is consistently operating at more than 80% occupancy. If and when the deal is consummated, it has the potential to add 100 brownfield beds to our network. For 300 beds at Dwarka, interior work is in progress, lifts are under installation, and external development has started. Medical equipment has been ordered, and as communicated earlier, we expect to commission the hospital by end of Q4FY23, subject to the developer obtaining occupation certificate by that time, of which we are quite certain. For 329 beds at Nanavati, the work is in full swing at the site. Foundation and column work have already begun. As you may be aware, Larsen & Toubro L&T is handling the project, and we expect to commission the facility by end of FY25. For 300 beds at Sector 56, Gurgaon, in Phase 1, D-wall work is complete and excavation is underway, while the civil contractor mobilizes for starting construction by end of June. In order to obviate the delays at Max Smart caused due to tree transplantation issues, we are fast-tracking the construction at Vikrant site, which is part of the same complex. We have received in principle environmental clearance approval and are expecting other approvals over the next 6 to 8 weeks. Lastly, we continue to actively but prudently evaluate inorganic growth opportunities for strategic deployment of our cash surplus from operations. With this, we open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Ashwin Agarwal from Akash Ganga Investments. Please go ahead.
Congratulations to Abhay and the entire team for delivering industry-leading numbers. We could not have thought 3 years back that, you could have delivered these kinds of EBITDA margin and grown from here on also. So, heartiest congratulations for that. Abhay, could you highlight what is your vision going beyond 3 to 5 years, beyond what have you announced in terms of organic opportunities, and whether you would be looking at the south and the other regions in the country? And secondly, could you own around 24% stake now, so would you like to increase your stake so that you can use the stock as an option in terms of acquisition, else you get diluted?
So let me start with the last one first. The consequence of this performance has been, firstly, thank you for the compliment. 3 years back when we were listing the company, one of the biggest critiques of the Indian healthcare or the hospital sector was that there are no free cash flows. You have to keep redeploying. I think, with 1,281 crores of free cash flows translating from 1,600 crores of EBITDA, which shows 80% translation of EBITDA to free cash flow. I think, we sort of answered that question. So, that is as far as I'm concerned, right up there as far as our achievements in the current year. Now, with respect to, my vision over the next 3 to 5 years, I think there is a multi-decadal opportunity in the Indian hospital sector. The kind of infrastructure which is required to be created, simply because, you need to address that demand. And we're seeing this every day. So all the cash flows that we are sort of generating, we would be redeploying it into this, and we would be looking at, pretty much every part of India. We have been very clear about 2 things, that we will only look at places where at least a few of our competitors have proven viability. We'll go there and we'll do it better, like we do in each one of the micro markets that we currently operate at. We have not been the first anywhere, but we are the first wherever we operate. So I think that is the sort of strategy that we want to employ. So, that doesn't sort of preclude any place. But of course, we like a cluster approach. If I have to just do one hospital in Kerala or just one hospital in Chennai or something, I wouldn't do it. We prefer clusters. So we'll be looking at chains and we look at clusters.
Anything on your stake in terms of using the stock as an opportunity in terms of M&A?
So look, I think, my stock, one of the consequences of our success is it reflects on the market cap and the stock price. If to buy anything meaningful, I would effectively have to leverage my current stock, which I'm not interested in doing because I don't leverage my stock at all. So I think 1% of the stock will cost me 500 crores. So pre-tax, that money is about 800 crores. As my only form of employment is Max Healthcare, my salary doesn't permit me to buy more stock.
Lastly, sir,
But I would not be afraid of diluting if there's a great opportunity. Let me just put it this way. When I say diluting, if there's a opportunity for a merger or an acquisition, for the growth of the company, I would not shy away.
Yes, that is what I was wanting to know.
No, there's never been an issue as far as that is concerned.
Would you be only city-centric in next 3 to 5 years in terms of opportunities, or you would also look into tier 2 opportunities? And do you have opportunities like Nanavati which give you a gateway to any big city?
No, absolutely. So I think, firstly, we are very happy doing tier 2, tier 3 cities also. Our highest ROC business is Mohali, second highest is Uttarakhand, is Dehradun. It's not Delhi and Bombay. And like I said, we will go to any city where any of our competitors, or 2 or 3 competitors, have proven viability. We have, I believe, a list of 21 such cities.
All the best, sir. Thank you.
Thank you.
Thank you. We have our next question from the line of Damayanti Kerai from HSBC. Please go ahead.
Hi, good morning. Congratulations for a good set of numbers. Abhay, my first question is on your payer mix change plan. So you mentioned we have seen upward revision in PSU tariffs, etc. So because of that, is there any rethinking from your side to bring the institutional bed share to 15-16%, which you highlighted earlier from 29% currently?
Sorry, so what's the question? No, yeah. So look, I think the trajectory is changing on account of two or three things. One is that we are finding marginally more capacity. We are operating in higher levels than what we were thinking of previously. So we are able to sort of keep that business and be able to do more. And you're seeing that in your margins month on month. So the best thing is that if you can, we were pushing down that business because we wanted to accommodate our preferred channel of CTI. Now necessarily you're always going to find some elasticity towards the end, so you see the operating levels becoming higher. Secondly, we've added more beds, so 100 beds is 110 beds is about 3% more capacity that is being added. Yet you see the number sort of still come down marginally. The third thing is that there have been an increase in rates as far as PSU is concerned, increase in tariffs, which will work well for us in the current year. And that's for about 20% or 30% of the total tariffs that they've sort of revised. They've revised it quite significantly by about around 70%. Sorry?
Only 4 line items.
Yeah, so 4 line items, but that time amounts to about 20% of the total. 20%?
No. So overall increase would be around 4 to 5% on the billing to the PSUs.
But the rest of the tariffs are looking to be revised they're saying by July. So I think we have a little bit of a wait and watch here. Because if we have the same sort of increase by July, because I believe it has been proposed that the rest of the packages and everything else is being revised. And July is the time which we've been sort of informed.
Okay, just to clarify, this 4 to 5% tariff hike is for the PSC contract so far, and you are expecting.
No. So what I'm saying is that the line items that they have raised prices on, the average price is around 70%. But those line items, in a way, the contribution of line item is around 10 to 12%. So that means the overall raise would be 4 to 5%.
Okay, and in July, another round of...
we are expecting another round of price hike. Then there is the rest of the items. They haven't touched the diagnostics, they haven't touched the packages, they haven't touched the other elements of the blood bank, etc. They haven't touched that. They just touched 4 items. One is room rent, for ICU, room rent for singles, and then the IP consult and OP consult. Only 4 elements have been changed.
But whatever they've touched is gone up by 70% on an average.
Okay.
So let's say there are 100 things, 100, if the revenue is 100, 12% of the revenue has been touched by them. They've increased that 12% by, let's say, about 70%.
Okay.
The balance 88%, we're expecting something to be done by July.
Got it. Okay, great. So my second question is on your average revenue per operating bed. Again, I think you have surprised positively quarter after quarter. In last 2 years, we have seen around 15% increase, and I understand specialty mix change is a big driver of it. So can you explain what has changed so significantly in last 2-3 years that you continue to see better and better specialty mix, and how should we see this part moving ahead?
I think, look, your ARPOB is being generated by payer mix and specialty mix. It's not only purely payer mix. You've also seen a massive increase in international business, which plays on to your ARPOB. So, it's a combination of factors. And, specialty mix, now you're looking at COVID in the middle, right? So I think your ARPOB vis-a-vis a COVID year is going to be higher. You need to compare it to a pre-COVID pre-COVID years. Then you take up perhaps the cost increases over this latent period of COVID, because the disease burden has come back after COVID. So in the middle, you're looking at COVID business, which was high occupancy but lower ARPOB, and now you have business which is essentially high ARPOB, but your occupancy sort of moved up because there wasn't any capital capacity creation for those COVID years. So I think you're going to see this sort of move up, but obviously you can't do a comparison with the COVID year.
Not even with COVID year. So if I look at the period of FY19 before COVID, you were somewhere at 47,000 ARPOB, and now it has moved up to say 70,000 plus. So I'm asking from that perspective.
So, what was the ARPOB? I'll just let you know what the ARPOB was. But look, I think as you move up the occupancy curve, right, you're going to distill your payer mix. Now you're talking about a time when my payer mix again, I think 40% plus was PSU. Now it's 29%, right? I think, as you go up the curve, you start getting that sort of operating leverage when you start getting that better quality of business. Okay, this thing is, we still have hospitals in the portfolio which are doing a 90,000 plus ARPOB.
Okay, so
our FY20 ARPOB was 50.3 thousand, right?
So it's 50,000, it's gone up to 70,000 in 3 years now.
So average is 67,000 for FY23. So you take year-to-year average. So it'll be 10-11% IRR.
So it's a 10-11% increase, right? From 50 to 67.
Yeah. So going ahead also say, since we continue to see better mix both in payer and specialty part.
I think from a payer mix itself, from distillation of payer mix, you should see an increase in this thing. And clinical mix, of course, like I said, there are always innovations sort of going on. It's not only at Max, but, we have plenty of a single hospital in Mumbai, for example, which have been, there for 20 odd years, which haven't sort of, there's no payer mix sort of saturated, there's no extra bed, not the square inch that they've been able to add. Yet the clinical mix sort of drives ARPOB up. I mean, there are lovely examples of that, Hinduja Hospital, Beach Candy Hospital, and so on and so forth.
Okay, so comfortably we should be seeing say high single digit to say double digit growth in the ARPOB going ahead also.
I'm not, I avoid giving any forward-looking projections. You know that.
Okay, and my last question is on your view on the competitive landscape in Delhi NCR market, given we have seen many of your competitors trying to step up their presence. So is there any possibility of bed oversupply in, say, foreseeable future, if not now?
I haven't seen any new beds come up in Delhi NCR or even under construction.
Actually, I think Apollo has a facility coming up in Gurugram. So,
I'm told there's some.
Yeah, it's going on for last 5 6. This facility is already there, by the way. This hospital was already constructed. I think Apollo has just done it was not operating. But I think this building is there for quite some time. So let's see when it starts to operate. It's not yet operational, right?
Yeah. Okay.
Yeah, there's some litigation issues. Yeah?
Okay, thanks for your answers. I'll get back in touch with you.
Thank you. We have our next question from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Hi, good morning everyone, and many congratulations to the management on such a superb execution. My first question is a kind of a clarification. When I look at the audited cash flow statement, the capex incurred under the line item of purchase of property is around 335 crores, whereas in the pro forma numbers that we talk about in the executive summary, the company has given a capex number of 208 crores. I guess there might be some technicality here. Can you please explain me why this difference in audited and executive summary?
So just to clarify that point. So I think when we report the 208 crores spend, that spend is on the capacity expansion, right? These are on the projects, 208 crores. So whatever is the routine capex in the cash flows that come in the property line, but eventually when we report numbers to investors, we take it out from the free cash flows, right? So when Abhay says that we have 1281 crores of free cash flow against 1636 crores of EBITDA, in that 281, that whatever amount that is spent, the total network spend is around 211 crores on the routine capex. That amount is taken out of the free cash flows, and we only report the number of 208, which is the on capacity expansion, which is basically ongoing projects. Does that clarify?
Yeah. So 335 is the right number to look at?
One is the routine capex, right? There's a replacement happening in the running hospitals, and one is the capex which is for the capacity expansions, right? So 208 is number for the capacity expansion. Whatever is the number on the routine, replacement in the hospitals, running hospitals, that is taken out from the operating cash flows. So when we say cash from operations, that number is already netting there. But in the audited financials, that number, by virtue of the fact that the cash flow is as per a particular India's requirement, that number also, both numbers flow into that number.
Okay, so 335 is the right number to look at when we are looking at on a pro forma basis?
The number will be around 419 crores because what you see is only the consolidated financials, right? So these consolidated financials don't have the PHF numbers, the partner health facility numbers. The overall number, if I take the net worth cash flow, will be 419 crores, of which 211 will be routine capex, 208 will be trustee expenses.
Okay, 419 crores. Okay.
Yeah.
And sir, in the cash balance, there's a difference of 100 crores again in the audited and the pro forma balance sheet that you have given. Some technicality here as well. Can you explain that, please?
You understand that I think if you read the very first page that we put out there in our investor update, you will find what the difference is for, right? So basically, we have this PHF where we control the medical operations through the hospital management committee, right? So we have a 3:2 ratio. We control the operations, but since it is a medical services agreement, we are not able to consolidate the financials in the group financials, right? So what we do is that we do a memorandum consolidation that is certified, and that's how we report numbers to the investors, right? So if you read the very first sheet, that will clarify this doubt that you are reading.
Understood. Got it. Sir, on the bed expansion plans, I think in the last investor presentation there was the bridge that you share regularly. Now that Shalimar Bagh has come on stream, we should refer to that bed expansion plan in the previous investor presentation. That still holds. How should we look at the expansion plan?
That's right. It's just for which we said there's a little bit of delay. Okay, everything else is going to be online.
Okay. And what's the capex plan for FY24, both routine as well as ongoing projects?
I think routine is about 150 crores, 170 crores. 170 crores, and capex will be 900 crores. 900.
So 900 plus 170.
900 crores will be for the capacity expansion, which is on the ongoing projects, and around 170 will be on the routine.
Okay, understood. On the international footfalls, how should we look at growth in this business in the coming 2-3 years? Now, FY23 has been pretty strong at 43% kind of a growth. Do we expect to grow in FY24 as well on this particular base? And not just short term, what are your thoughts on a 2 to 3 horizon as well? What kind of growth in the international business?
I think, like I've said numerous occasions before, there's an exponential opportunity. Okay, what we are seeing is only incremental. And now the government has sort of put its weight behind it, so hopefully we'll be able to tap it in the medium run. But in the short run, we will still see incremental gain. I am going to avoid giving you any sort of guidance on the numbers, like I sort of avoid in every other financial parameter as well. But so we believe this is a space which is we are not even hit the tip of the iceberg.
Okay, understood. I also read somewhere, I don't know how true this is, that Delhi NCR accounts for almost 70-80% of international footfalls that come into the country. Is it the, sorry?
40%.
40. Okay, got it. And one final question, the tariff hikes, whether on the PSU front or whatever you're contemplating on the packages side, is it a reflection of supply-demand balance being in favor of private hospitals at this point in time in Delhi NCR? And do you foresee that this is likely to be an industry phenomenon, not just specific to Max?
No, it's an industry phenomenon. I mean, will not CGHS, etc. rates are for the whole country.
This is in response to the news flow that had come in that government has allowed some price hikes on the CGHS side.
Yes.
No. And by the way, this is after, the last price was fixed in 2014. So it's a revision after 9 years, in a way, by CGHS authorities.
Okay. But you're also considering revising prices for the packages, right? I mean, which is on
the government as government.
Oh, so that's also on the government side.
Yeah. So they just provide the prices for 4 elements. Other clean items, for example, pathology, radiology, blood bank, packages, surgeon charge, etc. All those things are under.
A lot of things we do under package, right? It's not itemized billing. We say CBG, okay, or whatever. C-section. Okay, if they haven't increased the C-section or the CAPT. They've increased the room rents, the doctor visit charges, etc., etc.
Okay, understood. Thank you so much and all the best.
Thank you.
Thank you. We have our next question from the line of Lavanya from UBS. Please go ahead.
Hi, thanks for the opportunity and congratulations on good set of numbers. So most of my questions are already answered and I just wanted to get a clarification on these packages. So is the tariff hikes is only related to CGHS packages or is it something related to diagnostic business of Max also?
No, so right now they have not increased the diagnostics. Okay. Like Yogesh mentioned, out of only 12% of the revenues, okay, or line items which account for 12% of the revenues have been price increases happened over there. It's up to 70%. 88%, which includes diagnostics, includes packages, includes a lot of other things, okay, has not happened, which is under consideration by the government, and we are told by July there may be some visibility on this. So, ma'am, don't mix the CGHS price increase with the other price increase, right? So there's a 29% bed share is by PSU, where the tariff is given to us by the state, right? Central government, actually. Yeah, so we are talking of that element of the business. The other business, we do increase prices. We have increased prices on 1st April. We also increase prices with the insurance companies as and when the contract becomes due. So I think don't mix the two, right?
Yeah. So that's the reason I'm just asking for clarification that this is everything, the discussion is related to CGHS and nothing related to the Max. Max Diagnostics is different, right? Yeah. So Max Diagnostics, are we expecting any, are we planning to put any price increases for just diagnostic business?
So we haven't for CGHS or just generally?
In general Max Diagnostics business.
So there are two elements to the diagnostics. One is in-hospital diagnostic, other is outside. The in-hospital diagnostic, we do increase prices every April, and we've done some bit of it in this year also. And the non-captive pathology business, the retail business, we haven't increased any prices yet.
Got it. Thank you there. And on the ARPOB, I understand that increase in ARPOB is supported by higher international contribution this quarter. So do you expect increase in international business in the coming year, FY24, or do you think that we have reached the optimal level in Q4?
I think I answered that question in the last thing. Like I said, there's a immense opportunity, exponential opportunity. In the medium run. In the short run, it is still incremental. Nevertheless, I think it's clearly it's only incremental.
Okay, got it.
We're nowhere near the peak. With the sort of comparative advantage that we have, there's no reason for it to sort of slow down. It should only snowball and become much, much larger.
Got it. So I just wanted to check because we have already crossed the pre-COVID level. So it should be incremental from here, but not a jump or significant jump that we have seen over the last few quarters. So I just wanted to check that.
So it's a 10% growth quarter on quarter, right? In international, even pre-COVID, you had a very good clip of growth. So if you look at what the even pre-COVID levels, okay, the growth rate was not slow. Actually 2 years later to go up 20% over pre-COVID levels, you still haven't got up to the rate of growth.
Okay, got it. Thank you so much for the opportunity.
Thank you. We have our next question from the line of Sangeeta Purushottam from Cogito. Please go ahead.
Hi, this is Andre, Sangeeta's partner. Congratulations for a great set of numbers. And I just want to find the 87% increase in PAT on Q4/23 compared to 22. I can make out that there's been an increase in international business. I can make out that there's been a decrease in institutional business. I can make out that there's an increase in occupancy. Could you give some more granular insights as to what are the elements of the channel or payer mix that have contributed to this 87% increase? And if you think that many of these profit drivers will remain in the future.
You want me to describe this 87% increase in fact?
Yeah.
An item before that.
No, not every line. I'm just saying I identified, as I said, 3 of those factors. Could you just give us a broad sense of which are the other specific factors, when you say channel mix and payer mix that have additionally contributed to this 87% increase?
I think, it is payer mix, it is clinical mix, it is better cost management, lower consumption ratios, lower, finance cost, lower. I think it's pretty much everything, but cost management other than payer mix and channel mix. And yeah.
So anything specific in payer mix apart from what I outlined? Or channel mix?
Payer mix is reduction reduction in PSUs, increase in international and CTI business.
And sorry?
The cash, insurance and international business has grown.
Okay.
Okay. Effectively it's that. It's not about reducing PSU, but it's about increase of these 3 elements.
And you think that the operating margins of 28.2% or so are maintainable in the future?
Look, I focus more on EBITDA per bed, not operating margin. Because you'd rather do a $10,000 surgery and have a 20% margin than do a $2,000 surgery and have a 50% margin, right?
Right.
Okay, so I think the question really is the EBITDA per bed. Okay, even if it means lower margins tomorrow, is the EBITDA per bed going to increase tomorrow or not? Because that's really what matters from EBITDA overall standpoint, growth standpoint, as well as ROC standpoint, right?
Right.
That, in my mind, will grow.
Okay.
You continue growing.
Yeah, and also all the levers are. We have numbers. Quarter 1 was 26.6%, quarter 2 was 27.7%, quarter 3 was 28.3%, this quarter is 28.2%. So obviously that means it's consistent, right?
Okay, great.
Over last quarter, there's been an increase in EBITDA per bed. Right. But if you see margin, it's marginally lower actually.
Right.
But we are happier about the fact that EBITDA per bed is increased, right? That's why your overall EBITDA is increased.
Okay, great. Thanks and congratulations once again for a great.
Thank you so much.
Thank you. We have our next question from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, good morning and thanks for the opportunity and congrats on very good set of numbers.
Thank you, Prakash.
Yeah, sir, just trying to understand this, the 4 to 5% in price increase is limited to the 17 to 20% of the total mix, right? Is that right?
No, because 29% of the beds are occupied by the PSU, which constitute around 17.5% of the revenue, right?
Exactly. Okay. So 17.5% moves up value terms by 4 to 5% in terms of pricing.
So yes, so I would say if nothing else happens, then there's a 4.5%, 4 to 5% increase in the price. Now we do expect the price increase in the other elements because you can't increase the room rent.
That is fine.
Billing the surgery as open surgery. You have to increase the packages, right? The moment you admit that the room rent has to go up, that means that's lower.
So the current one is 4.5% on 17.5%.
Yes, right? Yes. That's what I'm saying.
And you also mentioned that in some of your, every year you take some price hike around April. So that is more standard across the board in the hospital business?
Yes, that's right. Yes.
So that is 2-3% or it's like a high single digit kind of?
No, it's that 2.5%.
Okay. So what I'm trying to understand, we had fairly good ARPOB increase last year and couple of years. Just in terms of headroom of growth, we do have international lever, we do have case mix, payer mix lever. So that 10-12% is not way too off to model for this year as well. Would that be right?
I'm going to avoid giving you guidance on that, Prakash, like I always have. But there is no reason for it to not plan.
Okay, perfect. And secondly, on the volume side, occupancy side, so we on a blended basis is 77 and we would be having few hospitals which are 80-85%. So I'm just trying to understand the headroom in terms of, you mentioned that you have focus on growth in the preferred channels, which is more on the pricing, but immediately how can we improve the occupancy, or we are already operating at a optimal level of occupancy?
No, look, I think certain places, okay, where you have absolutely hit the capacity sort of this thing, over there you'll automatically start distilling. So the levers that we have are the following. One is that at the very sort of end, when you start pushing the envelope, there is some elasticity, right? In terms of operations. So what we were earlier 75, 76%, now 77, 78%. We also operated 80, 81%. So each one of these facilities will have a sort of more efficient system of discharging and so on and so forth when it starts coming to the coming to the edge. Second is, we had mentioned there's about close to 100 odd beds, okay, internally that we unlocking. 10 beds here, 20 beds here, 30 beds here, so on and so forth. So 100 beds is about 3% of total capacity, okay. A couple of percentage points through occupancy, that gives you about, let's say, 4 to 5%. On top of that, we also have, the payer mix sort of distillation that we can do as and where necessary. Third, finally, but what you want to do is, first you want to maximize on the first two. Then you want to move to the payer mix distillation. And then finally you have another 300 beds coming, and then by next year, every hospital will sort of have its own beds coming through.
Got it. And this care, this Hyderabad one is finally not happening, right?
Well, I won't say that because we've sued for specific performance and matter is in arbitration. The sub judice, I won't go into existing, but we have asked for specific performance over there.
Okay, because I read Blackstone getting into that, so I was just checking on that. Okay. And lastly, on the regulatory side, of late there's been a lot of news flow, on having reservations for the government as well as the poor and the needy. There's too much, unverified information. So is it happening some bit? Is it already happened? It was already happened, in the past, and it's just a rehash, or if you could just...
I think you rightly put it. Firstly, I think there's way too much being made out of something way, way too little. Because first and foremost, please understand, there is already a right of health across the country, okay, through a Supreme Court sort of this thing. If a patient comes, is dying, a trauma patient comes into a hospital, you can't say, show me your wallet first. You have to take him in and stabilize him. That is right to health, even as per Supreme Court. And no hospital would ever even think of not doing that. Really, if somebody was to do that, you'll read it in the papers. That's how rare it is. And you've seen those situations before in the papers, etc. No proper hospital will, let's say somebody comes to a hospital, okay, is the accident patient, a number of these patients come year on year. If we were to actually reject that patient, firstly, it's against our own policy, okay? It's against Supreme Court strictures. And more importantly, do something like that, the media will string you, will hang you. It's inconceivable, any of these things. Secondly, most states like Delhi NCR, Delhi already for the last 10 years has this Delhi Arogya Shri Kosh, which basically means that, look, any accident victim comes over there, we will pay you some money for it. Now, the fact is, the government sort of, in any case we were doing it free, the government rides on it because they get, political sort of mileage by saying, no, we are actually buying your health care sort of thing, okay, and therefore we are paying people for the emergency use. Now in Rajasthan, they pretty much rehash the same thing, and they said, no, right to health. Right to health in emergency, which already exists.
So this is limited to emergency and not routine surgeries, etc.?
Purely emergency. Even in Rajasthan, it's purely emergency. In fact, they've diluted it down by saying it's not to the private sector. It's only to the to hospitals which have been funded or subsidized by the state government.
And also the trust hospitals.
Rajasthan government, and which itself doesn't make sense, because it's not as if a private hospital somebody goes, okay, you're going to reject the patient. You're going to still do it free.
And just one last one on the trust hospitals, we also do a set reservation for the poor and the needy. Is that right?
That's right. So every quarter when you see our results, you'll see those numbers being announced. So not only trust hospitals, but some of the hospitals where we have this auction, we bought the land in auction, in the company, in the listed company. There was some obligation to have 10% bed free, and we do provide for them.
Okay. And lastly, congratulations for Shalimar Bagh, turning it EBITDA positive in month 1 itself in March.
EBITDA positive in the first month and giving a 35 to 40% EBITDA margin on the incremental revenue. And this is something we've always spoken about. Brownfields do not suppress your EBITDA. They are accretive almost, we always said break even in the first quarter or two. And obviously we're going to give you a more conservative sort of this thing. But you've seen that. You've seen the operating leverage coming.
No, that is great. Thank you and all the very best.
Thank you so much. Thank you, Prakash.
Thank you. We have our next question from the line of Tushar Manudhane from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity and congrats on good set of numbers. Sir, on PSU tariff revision, will that, how much of the spread would get reduced in terms of EBITDA per bed with this price hike compared to, say, non-PSU or non-institutional patient EBITDA per bed?
EBITDA per bed, price hike.
No, the perspective here was that we are already in the hospitals where we are already running up at a very high occupancy. So that way we have a choice in terms of selecting the patient or distilling the patient, as you pointed in the earlier commentary. So just trying to understand, is this sufficient enough to reduce that spread for EBITDA per bed through the patient payer mix?
No, it will not. Answer is it will not. But what happens is that, look, if tomorrow I want to switch off 100 beds, right? Yesterday I only needed to fill 100 of PSU beds. Yesterday I only needed to fill 40 of those beds to break even, to make back the money that I'm losing by switching off 100. So I get 60 more beds to sort of this thing. Now that number from 40 is gone to, let's say, 55. Okay, tomorrow that number will go to 70 or 80. So what happens is it becomes marginal. But does it get to the same amount? No. So yes, I think what you're going to do is your trajectory sort of changes, but directionally you're going in the same direction. Albeit you're doing it without impacting, or it's actually a more preferred sort of, obviously you're taking a fiscal call basis that, look, it is going to be more accretive with these new numbers rather than less.
And if you could also clarify this, so this PSU tariff or PSU patient pool is, the proportion of PSU patient pool is higher in which hospitals, or rather, which cluster of hospitals of Max Healthcare?
We don't normally give. No, so we don't give you hospital data. But I think you can understand the hospitals which are more fuller, there the proportion will be lower, and there it is less full, they'll be having more. Higher occupancy, we obviously moved away from that, right? The lower occupancy places is where, like Yogesh said, where you have a higher amount of this thing. So anywhere where your occupancy is getting higher to 85%, you start moving away from this business, right? You start distilling it over there. You do the business where you have idle beds.
Understood. And so lastly on this Gurgaon thing, is any more land coming up for auction? Because we've seen other hospitals also having some land parcel in this area. So is there more area available for hospital expansion as such, or this is more or less done from the government side?
No, look, I think, it's like Bombay, right? I think you can have central Bombay, you can have, some place in Mumbai. Okay. So if you look at Gurgaon, the question is Gurgaon extension, now there's extension to the extension, etc. But where? On the main golf course, on the main district, etc., there's no land available.
Understood. So the intention to understand was within that particular area where the hospital space is supposed to be, sort of premium. So in that space, there is no land parcel available.
Not that we know of.
Okay, sir. Thanks. That's it from me.
Thank you.
Thank you.
We have our next question from the line of Raj Rishi from DCPL. Please go ahead.
Yeah, hi. Just wanted to find out, presently, obviously, the situation is great for you guys. How long do you think this supply won't come in, looking at the present fantastic scenario?
Sorry, which supply?
Like right now, the demand-supply gap is huge, right? That's why occupancy is what it is. So whenever the situation is so robust, obviously new supply is going to come in the various geographies. So how
Not necessarily. I mean, no new hospitals come up in Mumbai in 20 years.
Okay.
Right? Because there's no land available. No new hospitals come up in Delhi for 12 years. Maybe one. Okay, because no land is available.
Okay.
How do you get land in these metros? And land at viable cost, right?
Yeah.
If you want to buy, you have to understand there is a height limit of 45 meters when you set up a hospital. So you want to set up a 400-bed hospital, you need 4 to 5 acres of land, contiguous land. Where do you get it in Delhi and Bombay?
That's right.
I mean, it's like saying putting up hospital. So one of the biggest plus points that we have is that we have this land in our network, in our system.
Okay. And Abhay, how you had mentioned about medical tourism going up many times by 2030. So how do you see it? Like, what is the size presently, and where do you see it in 2030 for the sector? I'm asking.
If you are saying 2030, I think there's such a massive comparative advantage that we have in India. I mean, we are less than 5% of the cost of the US. We are less than 30% of Singapore. We are less than half of Thailand. I mean, look, it's not my case people from the US will start coming to India, but in my case, that the largest part of the world pyramid, so the bottom is all self-paid, right? And for them, affordability is an issue.
Yeah, that's right. And another thing, how do you see
this kind of comparative advantage? I mean, look, this has a potential of surpassing the IT sector. That's the amount of comparative advantage that we have.
Sorry, I didn't get it. Can you just repeat the last bit?
Sorry?
Just repeat the last bit. I didn't get it. It has the potential to surpass the IT sector.
Absolutely.
Achha.
I think, because the comparative advantage that you hold in this, no other country even comes close. Whilst in IT, other countries may come close. Here, there's nothing. I mean, the sheer volumes and complexities our doctors handle. What they do in a year, the Western counterparts don't do in a decade. Our skill sets are right up there. Our cost is a fraction of the global cost. Aging population, rising costs, most governments, treasuries going bankrupt. You see, this is going to be this is going to be something else. This is not even the tip of the iceberg right now.
Achha. And Abhay, another thing, just a thought, like generally when private equity guys, are so heavy on sector, it seems that it's, sort of topping out. When smart guys like Imami or Manipal, they dilute and private equity guys buy. Is this a thought? Huh? What are your comments on that?
No, I don't disagree. I think, you had hospitals and hospital chains, change hands many times. So Manipal, I think, this is the 6th or 7th private equity round that they've done in Manipal hospitals over the last 10, 12 years. If I look at, it's not as if Max wasn't up for sale. We bought Max, right? It's not as if other hospitals were not up for sale. Those transactions also happened in the past. I don't think it's a question of tapping out. I think, there is very clearly a multi-decadal opportunity, to invest in this sector. In India, which has never been actually, it's much more true today, but it's not something which was lost in the past either. Only difference was the biggest critique, and I remember when we were listing the company in 2020, and most of you will bear this out, right? The biggest critique of this sector was that the Indian healthcare sector is a great discipline of mirage because there are no free cash flows. How do you invest? You have to keep raising money and keep reinvesting.
That's right.
We have a 1,281 crore free cash flow coming with 1,630 crore. That's 80%, almost 80% throughput of free cash flow. And you're seeing this. We are not raising any capital. My entire 2,900 beds, is at a cost of 4,500 crore. That shouldn't even be 50% of my free cash flow in the next 4-5 years.
That's right.
That's a debt-free balance sheet. Today, look, this is the compounding. There's a massive multi-decadal opportunity to invest. I think, and to create infrastructure. So PE and all sorts of funds are going to be coming in.
Okay. And Abhay, just one last question. How do you see this asset-light model? How heavy can it be for you guys?
Sorry, just to understand one thing. A PE puts in money, at valuations.
Yeah.
And they need to underwrite. Any private equity will need to underwrite a 20 to 25% IRR in dollar terms.
Okay.
So only because they're seeing this opportunity, and I believe Manipal, for example, was done it 50 times, 2024 EBITDA. And those guys are expecting to do a 25% CAGR from there on dollar. So, I mean, on the contrary, I think when PEs come in, they see opportunity.
Okay. And Abhay, one last question about the asset-light model. How heavy can it be for you guys? Like, are you thinking of increasing that part of the business?
Well, it can be light, you mean? Yeah. So, you mean asset-light business being heavy? I think quite heavy from that standpoint, and I think over the next couple of quarters you will be coming across some announcements from us on this front. This is really the way for us to grow, particularly with any form of greenfields that we're looking at. We don't like to build on our own. We like to collaborate because it defrays the construction and the development risk, particularly in geographies that we're not presently present in. So I think you're going to see some of those come through now.
Okay.
So that's going to be a big focus area for us. Okay. You know, we have a 36% cash on cash ROC, so we can afford 8% yield to developers.
That's right. Thanks a lot, Abhay. Thanks.
Thank you.
Thank you. We have a next question from the line of Neha Manpuria from Bank of America. Please go ahead.
Thanks for taking my question. Abhay, you mentioned improvement in specialty mix quite a few times. And if I were to look at the chart where we show the profile, obviously there's improvement in oncology, a little bit in neuro, cardiac. So, are the beds that we are adding essentially focusing on doing more higher ARPOB work, like adding more onco beds, etc.? Or are we seeing the kind of work that we do within cardiac, within neuro itself increase that is improving this specialty mix? So how do I differentiate between the two?
So, okay, I think it's a combination of the two, obviously. So first and foremost, if I look at capacity spread, right? I mean, and you look at the overall ARPOB, your ARPOB that you see of 70,000 is a summation of ARPOBs, right?
Mm-hmm.
Like when you see occupancy of 77%, it's a summation of various, it's a weighted average. It also means there may be some hospital which is operating at 70% occupancy. There's another one which is operating at 90% occupancy. Similarly, in ARPOB, okay, you'll have certain departments which are low ARPOB. You'll have certain payer mix which is lower ARPOB. And yet you are hitting, let's say, capacity thresholds. Firstly, if you are hitting capacity thresholds, okay, you're going to look at expanding over there. Okay. What you would seek is that, look, if today I am creating more capacity, okay, and I was to take my lowest payer mix and my lowest ARPOB specialty, that's really what I'm creating it for. Are you with me? Because any expansion that you're doing is sort of serving the lowest common factor, because that is what you're doing it for. Otherwise, if you were not to do that brownfield expansion, what you're going to do is you're going to tap out, you're going to distill your payer mix and you're going to distill your clinical mix.
But, it could also be, I'm asking this, okay, one is, let's say I'm adding more onco beds or I'm adding more, OT or ICU beds because of the improvement in the clinical work.
What's the onco bed? A lot of the listing is fungible except for some daycare, etc. that you have, but the beds are similar. I mean, for cardiac, for example, there may be some cath lab, but the OTs are similar.
Correct. But
it's sort of quite fungible within the hospitals. You have to understand that. Yeah, I may segregate it and may do some clinical program, but the way I will value it, please understand this, right? I mean, if I have 100 beds, okay, of which, let's say, 50% beds are very high ARPOB and 50% beds are low ARPOB, and it's fully occupied. When I look at creating another 50 beds, the way I calculate it is that, look, if I was to take my lowest ARPOB of 50 beds and were to put it over there.
Yeah.
Because alternatively, my opportunity is to just play the lower ARPOB out and occupy my current facility.
Correct.